Charts are all about making sense of markets, making sense of it typically in a visual way, trying to reduce the confusion and noise of the everyday price action, revealing patterns and suggesting moments of entry and exit to make money. Another way of rationalizing a market is using moving averages. If we consider a market that's represented by bar charts, daily bars, the problem with the trader is trying to capture a trend or spot patterns. If we, instead of looking at these things as individual things, we try and smooth out the price action, we get by using a moving average, we sometimes reveal patterns that we might not otherwise see. That's the first thing the moving average does. It smooths out the visual representation of the market, and sometimes, as I say, it reveals patterns that you couldn't otherwise see. For example, very often you might reveal a head and shoulders bottom inside this price action that wasn't apparent in the pure bar chart. That's the first thing that moving averages do. The second thing is about moving averages, and it's a very powerful quality, is they can suggest moments when the market is overbought and oversold relative to the average trend of the market. And of course, an overbought and oversold situation is a trading opportunity. They do this obviously through the smoothing action. When the market goes beneath the average, there is a tendency for it. This quality of averages and the idea of overbought, oversold is best represented by the idea of mean reversion, reverting to the mean. So the markets oscillate around the mean. If you look at they do that. And the idea is that overbought here, you sell an overbought situation and buy an oversold situation. Once you've grasped the idea of mean reversion, there are lots of sophisticated statistical ways of dealing with that. The first is, for example, of using two averages, one long, one short, to, as it were, automate the mean reversion. So the first way, as it were, degree of sophistication is to capture this notion of mean reversion is by using two averages, one long-term and one short-term. In equity terms, people love the 200-day moving average and the 20-day moving average. The 200-day moving average might be like that, and the 20-day moving average might be like that. The two averages combined, when this distance is greatest, suggests overbought, and when it's greatest on the downside, it's oversold. So that creates an automatic, looking at the distance between the two averages, creates an automatic buy-sell situation. You can imagine if if we're just purely looking at the differences between these two things, it oscillates, and this creates an oscillator. But stick with this for a second. The two moving averages thing is an overbought, oversold indicator. There is a very sophisticated, popular version of that, which incorporates volatility, and called Bollinger Bands, invented by John Bollinger. It's just taking the idea of mean reversion to another level because it incorporates volatility. And the overbought and oversold indicators incorporate standard deviations, and standard deviations are measures of volatility inside a chart. And so he creates, instead of just using short and long-term averages, he has a sense of overbought, oversold relating to volatility. So if the market's very volatile here, these bands will expand out. And so in a very volatile situation, the market has to go even further before it can be regarded as overbought or oversold. So Bollinger, his great, as it were, advance was to incorporate the notion of volatility into the notion of overbought, oversold, so that in a volatile situation, the market has to be even further to be overbought, oversold, and in a very quiet situation, they come in. So you can be overbought, oversold in a very quiet situation with very small movements. So he tries to incorporate that notion of volatility.